Hello, Pathfinder community. Thank you for joining us for another Back to Basics webinar. The topic for today is understanding cryptocurrencies. First, I want to start by introducing myself. My name is Zachary. I'm a certified financial planner and wealth advisor with Pathfinder Wealth Consulting in Wilmington, North Carolina. We've been hosting these Back to Basic webinars for a few years now as a way to educate and inform our clients and community on a broad range of financial topics. Today's presentation is a hot topic that has been making headlines for the past several years, mostly due to the price increases in some of these digital assets or cryptocurrencies. As a disclaimer, one thing we will discuss today is the unregulated nature of cryptocurrency. As fiduciary investment advisors, which we are here at Pathfinder, we cannot by law promote, solicit, or recommend cryptocurrencies or related products in any way. Today's presentation will be educational in nature and is a response to some questions we received from clients asking, what are cryptocurrencies? What is Bitcoin? And are these something that I should be involved in my investment strategy? We hope that today's conversation will shed some light on what these things are and whether they are suitable for your financial situation. So let's get started. First, what is a cryptocurrency? Cryptocurrency, often referred to as coins, is a form of digital asset based on a network distributed across a large number of computers. This decentralized structure allows them to exist outside the control of governments and central authorities. Cryptocurrencies are secured by a process called cryptography, which is a form of encryption that makes it nearly impossible for it to be counterfeited or double spent. There are unique codes assigned to each one of these coins to prevent them from getting spent twice or going to two different individuals. The decentralized networks that cryptocurrencies are on are called blockchains or blockchain technology. As new coins are uncovered through a process called mining, they are cemented in time through this blockchain technology. Again, one of the most notable things about cryptocurrency is that they are not issued or sponsored by any central bank or central authority. This makes them theoretically immune to government interference or manipulation. As we'll talk about, this can be a risk too. When you purchase coins, they are stored in what's called a digital wallet. Each wallet has a unique address similar to a bank account that's unique to the individual. Some of the reasons that cryptocurrencies are praised is for their portability, since they're easily traded back and forth. They're also easily divisible, so you can buy fractional shares, which are difficult with individual stocks. So with the current price of Bitcoin trading at around $59,000 today, you don't have to shell out $59,000 each time you want to buy a coin. You can buy a small fraction and purchase in dollar amounts to be able to get access to these currencies. As with any currency, inflation resistance is a key theme, and it's the same with cryptocurrency. This means that it has natural inflation resistance and should keep up with rising prices over time. One of the big ones is the anonymity of cryptocurrencies. This means it's very difficult to track the owner of these coins because of the strong blockchain encryptions or cryptography unique to each blockchain transaction or each coin. This method, this cryptography and the blockchain technology is very transparent, and it's basically a ledger that cannot be manipulated or changed over time. It's kind of like a crowdsourced technology where rather than one central party or entity controlling the currency, it's controlled by all of the individuals that own these currencies and these coins. On the other end, cryptocurrency is criticized because of the anonymity and the portability. For example, it has been used for funding illegal activities such as terrorist activities. Another negative is the exchange rate volatility. So for example, if you have Bitcoin and you want to convert it to US dollars or maybe euros, the volatility of those exchange rates can differ what you actually get in that conversion. And then also the vulnerabilities of the infrastructure. So because of the popularity and the volume of a lot of these transactions, some of these crypto exchanges or the coin technology themselves were not prepared to take on that level of activity and has created issues. In addition, hackers and scammers have infiltrated some of these technologies and have left some of them open to security breaches and things of that nature. Okay, so next let's go over some of the common types of cryptocurrencies. Right now, there are over 9,000 different cryptocurrencies out there. However, about 4 or 5 of them make up the majority of the market cap, and that number is growing by the day. As you can see, the top 5 cryptocurrencies cover about 77% of the market cap. In addition, there are about 2,000 dead coins that are no longer in existence, and that number is growing as well. The all-time market cap for cryptocurrencies is around $1.9 trillion currently. One of the issues, and you can tell by the number of cryptocurrencies that are out there, is that there aren't a whole lot of barriers to entry for creating new coins. Right now, Bitcoin is the most popular, but who's to say that another currency won't come up through the ranks and knock Bitcoin off as the leader? So while we're on Bitcoin, let's talk a little bit more about it. As we've mentioned, Bitcoin is the largest and by far has the majority of the market share with a $1.1 trillion in market cap. So as we just said, with the total market being at 1.9 trillion, Bitcoin has about 58% of the market share. Bitcoin was created back in 2009 by a largely mysterious individual or entity called Satoshi Nakamoto. That person or group has not been identified, but that is where this concept was created. Theoretically, there's a finite number of coins out there, said to be 21 million, and 18.5 million have already been mined. However, this technological process of mining coins has become more and more complex over time, so it's said that it could take centuries to get all 21 million coins that are out there. Also, theoretically, once those 21 million coins are found, the technology could be altered to create more coins available as well. Looking at Bitcoin in particular, one of the concerns for the long-term investment merit is the volatility in prices. This chart I have in front of you goes back to the beginning of 2017, once Bitcoin really started to pick up steam. Just from looking at the chart, you could see the volatility over time. At the beginning of 2017, one Bitcoin was worth about $1,000 US. By the end of that year, the price peaked to just over $19,000 by the end of the year, about a 1,900% increase in the price. I remember that time vividly. I remember seeing friends on social media saying that Bitcoin's going to be the next big thing and publicly encouraging their friends to buy into it. Eventually that hype wore off and the price plunged about 84% down to just over $3,000 per coin by the end of 2018. It came back to just under $12,000 per coin by mid-2019, just to drop again, bottoming out in March of 2020. From there, we've seen the biggest spike in Bitcoin yet, with an increase to as much as $59,000 per coin where it's trading now. There's been a lot of talk in the media about the hype surrounding Bitcoin, and this is why. There's even a recent announcement that Tesla bought a significant position in Bitcoin, which has helped put a tailwind on the price and led to some of the continued increases. Generally, when we start to get calls about things like this, it tells us that it's hitting the national media, and it also means that the price increases have likely already happened and the money has already been made. We'll go into more detail about the investment merit of a currency like this, but from this chart, you can see the historical performance and its significant volatility over the past several years. To briefly go over some of the other large players in the crypto world, we'll talk about some of the altcoins, a term for any cryptocurrency that came out after Bitcoin. The next in line is Ethereum with a market cap of $222 billion. Compared to Bitcoin's market cap of $1.1 trillion, Ethereum is relatively small but still has a significant market cap compared to some of the other coins out there. Ethereum came out in around 2015, and it's one of the most actively used cryptocurrencies. Another one that we hear a lot about is Litecoin. It's not the third largest, but it's in the top 10, and it's another popular altcoin. It's often referred to as the silver to Bitcoin's gold. Right now, it has a market cap of about 13 billion, so tiny compared to Bitcoin's 1.1 trillion. One of the negatives of cryptocurrencies that I alluded to earlier is that it cannot be purchased on public stock exchanges. But if you want a publicly traded alternative, there are a few options out there. The only option right now for something that tracks the price of Bitcoin is the Grayscale Bitcoin Trust, GBTC. This allows you to buy it on public exchanges, but there's a cost to it. You pay a 2% expense ratio to get access to that. Also, historically, it is traded at a high premium above its net asset value, which is the underlying price of Bitcoin. This means you're paying more than you would if you were to buy Bitcoin through a crypto exchange. However, as I do this webinar, it's actually trading below the NAV for the first time ever. As far as other options out there, there have been plenty of cryptocurrency ETFs that have been proposed to the SEC, but none have been approved yet. I read an article recently about Fidelity, who is pushing one through and trying to get approval. So we'll see if that's able to get to the market. Other options for indirect access to cryptocurrency is to buy into companies that are mining the coins or the crypto exchanges themselves. Coinbase, one of the most popular crypto exchanges, is planning an IPO, and when this comes out, that would be a way to get some exposure inside of a retirement account or an investment account. Again, not tied directly to the price of Bitcoin, but a way to get access to that area of the market. But keep in mind, even though there are becoming more and more options to get access to cryptocurrencies in public markets, the reason cryptocurrencies were created in the first place were to be a decentralized currency. So buying them through these alternative methods eliminates some of the things that cryptocurrencies were created for. The anonymity, the decentralized nature, and the fact that it's not subject to government manipulation. All right, so we've gone over some of the risks of cryptocurrencies, but here's a recap. As I mentioned before, one of the key praises for cryptocurrency is that they aren't regulated or sponsored by any central government or central body, but this is one of the major risks too. With investments, most investment firms have SIPC protection, and with bank accounts, you have FDIC protection. There are no protections with Bitcoin or other crypto unless it's through the crypto exchange itself. In other words, if the price goes to zero, you can lose a significant amount of money without much recourse. Or if there's a cyber attack, there could be no protection there either. Since cryptocurrency cannot be purchased through regulated exchanges, and you can't put them in a retirement or brokerage account, they have to be held in a digital wallet offsite, which is risky because these technologies are new. These platforms are built to purchase currencies and execute transactions, but they aren't really built to store the coins themselves. And as I've already mentioned, the scalability problems that plague some of these coins and platforms are another risk due to the popularity and the large influx of activity. Frankly, many of these platforms were not anticipating the volume and have had trouble scaling and adjusting their infrastructure to be able to handle the level of transactions and the storage of coins. I've also mentioned the low barriers to entry. There are already so many coins out there and more getting created every day. While Bitcoin and Ethereum are the most popular right now, that might not be the case always. If you compare cryptocurrencies to gold or silver, which are precious metals with a physical specimen, those are a finite amount in the world. You can't create gold in a factory. The fact that cryptocurrencies can be created any time, that affects the scarcity, which can alter the supply and demand relationship and put downward pressure on the prices of these assets. And finally, the lack of historical data and history is a risk. It's a relatively new technology, a very new world, and there's not a lot of certainty out there of how this is going to fit into our global economy going forward. Will it become accepted currency across governments? I don't know. I think there will be challenges to that because of the price volatility. This is concerning to investment advisors and should be concerning to investors that these products just don't have a lot of history. And the history you do have shows very volatile price swings. Here's another one of the key differences. With a stock, we can determine an approximate value or have an estimate of fair value by looking at the company's performance, management structure, profitability, and those types of things. There are a lot of fundamental and historical metrics that we can look at to help predict the possible movements of a stock price. But cryptocurrency, like gold or silver, moves purely on speculation, making it very difficult to predict. Also, the tax side of cryptocurrency has been an area that the IRS has struggled with. They currently consider it property, which means you are subject to capital gains tax like you would be with any other property or investment. Some of the major Bitcoin exchanges will issue tax documents or 1099s, but typically only if there's a certain amount of activity or certain dollar amounts exchanged. That means these transactions or the gains from them have to be self-reported. So as you can guess, a lot of these transactions go unreported. I would expect more scrutiny in this area as the IRS tries to grasp how this will fit into our tax structure. Obviously, because the tremendous price increases, the IRS wants a piece of those capital gains for tax revenue purposes. I also think it'll be interesting to see how law enforcement will be able to crack down and track and monitor any illegal use of the cryptocurrencies. In the last section, we'll talk about how and where you can purchase cryptocurrency. As I mentioned before, it's done through an online crypto exchange using a digital wallet. Coinbase is probably the most popular, but there are other options as well, such as Binance, Square Cash, or the Cash App. You simply transfer US dollars into your digital wallet and purchase the digital currencies through these exchanges, and you store them in your digital wallet on their platform. A few things to be mindful of are the transaction fees, transfer fees, and exchange fees from one wallet to another, or converting from a Bitcoin to US dollars, for example. I think Coinbase charges 1.5% for transfers from a bank account and 4% if it's done through a credit card. So you want to read the fine print, understand what these transaction charges are, and also read up to see if there are any protections, like I mentioned earlier with that SIPC protection on investor accounts, if these platforms have any reassurances for any security breaches or fraudulent activity. And to talk about storage for a moment, you also want to consider safe storage options for your coins to make sure you're not overexposed by holding your coins on the exchanges themselves. These platforms were created to execute transactions, not to store coins. With a significant amount of coins, you'll likely want to have what's called a cold wallet, which is a off-site method of storing coins. The most extreme example is putting on a flash drive that you can disconnect from your computer. The digital wallets that are held on the crypto exchanges are often referred to as hot wallets. And the final thing to talk about is whether or not you should get involved in cryptocurrency at all, and whether it's something you should look at integrating into your overall investment strategy or plan. In short, cryptocurrency, and any currency for that matter, is not meant to be a long-term investment. It can be used as a hedge and should protect against inflation over time, but in the end, I find it very difficult to see cryptocurrencies having sustainable growth over time like you should see in a typical portfolio of stocks and bonds. I totally agree that it will be a permanent part of our society going forward, but that doesn't necessarily mean the price will continue to appreciate at the level it has. And also, since cryptocurrencies don't pay dividends or interest, you're solely relying on the price increases for growth. There isn't anything else contributing to that, as it would with a stock that pays dividends or a bond that pays interest. Looking at the volatility just over the past 5 to 7 years, it looks like a penny stock the way that it moves. Very quick ups and downs, and frankly, most people can't handle that type of volatility. Yes, overall, Bitcoin has done very well and grown significantly, but trying to find those entry points is very difficult, especially when it's at a high point like it is right now. As with any investment, the best time to buy is when nobody's talking about it. Like in March 2020, when the price of Bitcoin was down to around $5,000 per coin and it wasn't in the news. Once you see it in the news, it might be too late. As with any investment or any financial decision for that matter, you want to consider how it's going to fit into your overall long-term investment strategy, risk profile, and financial plan. Thank you for listening to the webinar today. If you have any questions or are interested in seeing how this might fit into your situation, give us a call. Take care and stay safe.